What is a share buyback? Now, very often, especially when a company is getting a little bit old, and initially they've raised a lot of capital, which they have invested, and they've made good returns on that capital that they did invest. And then after a few years, they actually sit and they have a huge share capital, which was issued, and probably they have a lot of money in the bank and they don't know how to use that money productively. So in a case like that, the New Companies Act of 2008 allows company to buy back shares which were issued quite some time ago. Now we have to pass that accounting entries. Remember initially when we issued the shares, we debited bank, and through the allotment account, eventually we created share capital. So obviously, if you want to buy back shares, you have to give the investors the money back of what they have invested in the entity. But now it will be very, very bad if you only, let's say that you bought 100,000 shares at R1 each. You cannot only give the guy 100,000 Rand back. I mean, a time period has lapsed, and hopefully your company has grown in value over this time period, and therefore the value of his shares is definitely not equal to the original R1 per share that he has invested in the company. So probably we are going to pay him back R1.50 a share. Now, think about that. When the shares were issued, I debited bank through the allotment account, eventually credited share capital 100,000 Rand. If we're going to pay him back now 150,000 Rand, how much money can we take out of the share capital account? We can only take out a maximum of 100,000 because that's the only thing that's lying there. So the premium on the share buyback, that additional 50,000 Rand that we're going to pay the investor, that needs to be funded from somewhere. It can't be share capital, so what is left? Guys, the only thing that's left is retained earnings. So we're going to fund that premium on the buyback of the shares out of retained earnings. Let's do an example. A company had issued 100,000 10% non-cumulative preference shares for 200,000 Rand. So we've issued those shares at R2 each. 3 years later, the company decided to repurchase these shares at R2.20 per share. So obviously there is a premium of 20 cents per share that they're going to pay the shareholder. The transaction was finalized on 30 June 23 and the financial year end is 31 December. Dividends were declared on 30 June 23. Show all the applicable journal entries. Great. Now the buyback price we said is going to be the 100,000 shares at R2 a share. So that gives us 220,000. Initially, we have issued the shares for 200,000. So therefore, our premium, which is going to be financed out of retained earnings, is going to be 20,000 Rand. Then what we're also going to have to do, we are going to pay them a 10,000 Rand dividend. How do we calculate that? That equals then 200,000 Rand multiplied by 10%, which gives me 20,000 Rand, and that is only for a period. Remember, it's a time-based thing from the 1st of January up to the 30th of June 23. That was the date when this buyback took place. So therefore, the dividends that they've declared just before they've bought back the shares was 10,000 Rand. 200,000 times 10% multiplied by 6 months, 10,000. So they debited dividends, credited shareholders for dividends with 10,000 Rands. Then they paid the shareholders and they credited back. Now we're going to repay the capital. The amount that we're going to repay is 220,000. So bank is going to be credited with 220,000. What is the maximum that we can take out of the capital account? Only 200,000 Rand. So we're going to debit preference share capital with 200,000. We said that the premium is going to be the 20,000, which we've calculated there. So against retained earnings, we're going to debit with 20,000. So 20,000 of this amount of 220,000 is going to be financed out of retained earnings. Let's look how convertible preference shares are being treated. A company issued 5 years ago 50,000 10% convertible non-cumulative preference shares at R3 per share. Remember, a convertible preference share, in what are we going to convert that share into an ordinary share somewhere in the future? On 30 June 25, the company decided to convert 20,000 of that 50,000 shares into ordinary shares. Shareholders received 3 ordinary shares for every 5 convertible preference shares held. Dividends were declared on 30 June 25 and 31 December 25. Journalized the transactions. Right. What was the issue price? Initially, we issued those 50,000 shares at R3 a share. So we have raised 150,000 Rand worth of capital. We are going to convert 20,000 of that 50,000 shares. So 20,000 divided by 50,000 multiplied by 150,000 equals 60,000. So that is the maximum that we can get out of the capital account. We cannot take more because that is actually the amount which is actually representing 20,000 preference shares. So for every 3 ordinary shares, or they're going to receive 3 ordinary shares for every 5 convertible preference shares held. We're going to convert 20,000 preference shares divided by 5 multiplied by 3. So we're going to issue 12,000 ordinary shares. Now what is going to be the price per share? The amount that we're going to convert, we have worked out there, equals 60,000 Rand. We're going to issue 12,000 shares. So what is going to be the issue price per share? 5 Rand a share. So if I'm going to recap, I'm going to say initially we issued 150,000 Rand of pref capital. That equates 50,000 shares. Now we're going to convert 20,000 of that 50,000 into ordinary shares. So the share capital amount that we're talking about is 60,000. Now with a conversion, I just move one type of share into another type of share. I can never convert a share at a premium. I can only move the capital which represents this 20,000 shares out of preference capital into ordinary share capital. The only thing I want to know is how many shares am I going to issue which equals 60,000 Rand? Well, I'm going for every 5 shares, or preference shares that I've held, so 20,000 shares I'm going to convert divided by 5, I'm going to issue 3 ordinary shares. So in total, I'm going to issue 12,000 ordinary shares. If the total amount that we're talking about that we're going to convert is 60,000, and that represents 12,000 shares, it means that we're going to convert this preference shares at 5 Rand per ordinary share. Let's have a look at the journal entries. The first thing is the dividends that we have to pay on the 150,000 Rand. So 150,000 Rand times 10% multiplied by 6 months equals 7,500, and we're going to credit shareholders for dividends 7,500. Also on 30 June, we're going to convert the 60,000 shares. So we're going to debit convertible pref share capital and credit ordinary share capital. Can you see we just move it out of the pref capital account into the ordinary capital account? Then at the end of the year, we still have to pay our 10% dividend, but now not on 150,000, which was the initial capital amount, but on the 150,000 less the 60,000 that we have converted. So only 90,000 remained, multiplied by 10% for 6 months. That gives us then for the last 6 months a pref dividend of 4,500. We debit dividends and we credit shareholders for dividends. This is a convertible preference share, so it is an equity instrument, so therefore it is a dividend. It is only on a redeemable, compulsory redeemable preference share that we use interest, and we call it a non-current liability. All other preference shares are be treated as equity, and all amounts payable on that preference share is treated as dividends. I think that is before we start with taxes.